Trident Capital is a venture capital firm with more than $1.9 billion of capital under management. Kimon Boyiatjis, director at Trident Capital, joining us now from our Cape Town studios to share their investment strategy right now. Thank you so much for joining us this evening, Kimon. I suppose let's just start off with your view on what's taking place globally right now, because of course that EU summit is looming on Thursday. Many saying that we're going to see a sideways trading, cautious trade. Whether we'll be able to get anything concrete out of that is of course a big question. It's the 20th time that EU leaders have met within this crisis, so many doubting and skeptical that they'll be able to come up with anything credible. But your views on that and how it's impacting market sentiment right now?
Don't hold your breath on any news coming out of that. We've seen so many of these summits over the past couple of months that they come and go. So I don't think there's any real event. I expect the markets perhaps expecting too much from any of these summits. I think you've noticed that the Germans have dug in their heels, and I think that's going to impact negatively on the market. One would have imagined that they might have softened their stance, and I think that's what the market was hoping for, but it appears not to be the case. And the longer they procrastinate and they don't come up with any strong plan, the weaker it's going to be for the politicians both in Spain, Portugal. We've already seen what's happened in Greece, and it appears that Spain is likely to go, or there's a strong possibility that goes the same way as Greece. The recapitalization of the banks is going to be a huge drain. It doesn't appear to be a good plan for that. And if one had to take a step back, probably more of the same weakening of the euro relative to other currencies. I think the market's going to be spooked again, and no real will, it appears, by the leadership of Europe to do anything about it or anything concrete.
Kimon, when you look at specifically the South African market, and I mean, I know you're a great proponent of inflation-linked bonds, and I must say I agree with you, but in the very short term, let's say the next year in South Africa, it seems apparent now that inflation expectations have changed quite materially, in that people are now becoming bullish about inflation. You know, the oil price falling, food price falling, administered prices falling, etc., etc., that inflation could easily surprise on the downside. And we know that the real yield on inflation-linked bonds are still quite high. Aren't you worried in the shorter term about the prospects for inflation-linked bonds?
It's a really valid point, Wayne, and a point well made. And I certainly agree with you, and I am bullish on inflation coming down. But I think one of the principles behind my investment thesis is that when one looks at any portfolio, I really do believe that inflation-linked bonds should be a cornerstone of those portfolios. And my rationale behind that is really to take an inflation-linked bond and get a real yield. And that's actually the one instrument that helps me get what I'm trying to achieve out of a portfolio, and that's a real return over time. And I find that in South Africa, most of the portfolios are underweight these instruments, and they shouldn't be, because it's that single one asset class that helps you closest realize your objectives in a portfolio.
What's the time horizon there for an inflation-linked bond?
As inflation drops, what you're going to find is that you're still going to get that real yield over and above the rate of inflation, despite the fact that it's declining. So I think it's still a hold.
Talk to us about equities, because you've been selling some equities, you've been reducing your weighting in equities rather. Do you have any sectors that you specifically underweight on right now?
Well, I was overweight the resource sector for the first quarter of the year, and fortunately we took some money off the table at the end of the first quarter, largely because we weren't that clever. We didn't anticipate the downward move, but it appeared that the noise that we were seeing coming out of Europe was not going to be positive for the resource sector. But much more importantly, the rate of growth in China was falling, and we believed that it would be a more rapid fall than the market was expecting, and that made us a little cautious on the market. So we're very defensive in the equities that we do hold. We like even some of the international stocks, even European stocks, despite the fact that we might not like their market. So you want to hold stocks like SA Breweries. They are I think they're quite defensive. They're cash generative. Something like BATS is a good stock to hold. Richemont, which we don't hold, but it's a good stock. I just thought it was a bit rich. But those are the kind of stocks that we'd look to hold in a portfolio. The retailers have really done us proud. And although they are expensive, we exited that sector, and we can't blame anyone for holding them. If you want to be in that sector, we like the cash generative ones, and particularly ones that have got a big weighting in the food sector.
Now, Kimon, when you say you fortuitously exited the resource shares, they're now significantly lower than what they were. And you're sitting with Anglo-American Billiton. I mean, these are high-quality companies in the sector over time at 7 PEs. And it seems to me that China will reflate their economy. And not only do they want to reflate it, they have the ability to reflate it. Don't you think it's time to go back now and buy some of these shares? Because 7 PE, this is not expensive.
The one share that I do still hold is Anglo's. I do think it's the pick of the bunch. I do hear you, and the pricing is good. I think we've got our own political problems, as we may find down the way, which might have a bit of a bigger negative impact on the resource sector than anticipated. So yes, while we do hold it, it's not a massive holding in the portfolio, but we have got our foot in the water. I do think you'll have other buying opportunities, and I do think that the pressure will be on the market, and the PE might be low, but I think what we might find is that over the next couple of months there might be 1 or 2 shocks and scares, which will allow us to enter into that market even cheaper than where we currently are.
Kimon, what about the currency factor? Because of course we've seen the rand sharply depreciate. It's been, if not one of the worst, but if not the worst emerging market currency this quarter. So what do you do with the rand? 8 Rand 50 is where it's been hovering. It hasn't really broken decisively out of that. Do you diversify away from South African assets in order to hedge against currency weakness?
There's 2 parts to that. I'd like to answer it in 2 ways. I always believe where your liabilities are, where your assets must be. So I'm not a big proponent of taking money offshore for the sake of taking your 20% allowance to go and invest offshore. Don't just do it for the sake of it. That's also why I hold physical gold in a portfolio, because I do believe that is, my rationale behind that is actually for the currency hedge. If you are bearish, which I am bearish on the rand, I think that it will drift weaker. In order to take advantage of that, you go back to your tried and trusty, faithful rand hedge stocks. I think that's a nice place to be. But again, don't diversify out of South Africa when all your liabilities are here. And I think asset matching and liability asset matching is an important part of portfolio management. So it would depend on the portfolio that I was looking at.